Hey everyone, Anthony Venuti here with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to be talking about the Bank of Canada, March 2nd, the potential for an increase, as well as what's happening in local real estate markets, as well as what we're seeing in the mortgage and real estate marketplace as we move forward into the spring market in March. So stay tuned, we're going to dive right in. Once again, I want to take this opportunity to continuously thank all our viewers and supporters of the channel, everyone leaving us DMs and emails about questions, future topics, and suggestions for topics like this one that we're going to be talking about right now. And as we continue the financial literacy journey to help educate Canadians between everything from mortgages and real estate and understanding what's happening in the marketplace, especially if you're a home buyer, an existing home owner, and someone looking to get into the market, or maybe someone who's in a fixed rate mortgage or variable rate mortgage, this pertains to homeowners as well as future homeowners. So a lot of media coverage has been seen regarding interest rates and a lot of fear about 8 increases, 5 increases to the Bank of Canada policy rate. There's been a lot of economists coming out there and talking about how this is going to calm the waters a little bit or maybe pull it back. Now, from my experience, yes, depending on the amount of increases to the Bank of Canada policy rate, that could definitely pull a lot of the demand out of the market, as many Canadians who are already finding it hard and challenging to get into the market are going to see themselves priced out as the monthly payments will tend to go up. One important thing to understand, though, when you're applying for a mortgage in Canada, and when we look at the interest rates of where they could be or where they are, is that you are currently stress tested at 5.25% on a mortgage when you're applying, whether it be for a new refinance or a new mortgage. The only time you're not undergoing the stress test is if you're just renewing your mortgage. So when we look at clients, we're saying, look, you're priced in to the benchmark of 5.25%. Now, obviously, between what the discount is or the actual real rate that you're getting, there is a distinction in there, obviously. And when it comes to affordability, there is obviously a difference in between 5.25, what you're qualified for, and what you're actually budgeting for. So those are some distinctions that are very important, and you should be considering them. But as we look at real estate prices over the last few months, we've seen an average of about 3% increase over the last few months across Canada and across many provinces, as well as Calgary, Alberta. We've seen increases in PI. We've seen, obviously, Toronto, Vancouver, Montreal. Prices have gone very, very high, very, very quickly. And that is a telltale sign for me and this industry that when you're looking at things and saying, okay, why is this happening? Now, you're seeing in Toronto and some parts of the GTA inventory, which is homes on the market, are basically limited to about a month and a half, if not lower, depending on what you're looking at. And you're having a lot of buyers competing for the same style homes. And a while back, we talked about, some of the parameters around that. But when you have low inventory and high demand, obviously, you're going to have a lot more competition. You have more people chasing fewer goods. Now, this is something that's important to understand, because the government has basically made a very important distinction to say, look, we're going to be allowing 1.3 million new Canadians to come into Canada over the next 2-3 years. And that's going to put a severe strain on housing supply, because as it stands right now, we are at least 10 to 15 years behind the curve when it comes to meeting the demand for the buyers who want to own a home or people that are looking to make the move. So when you start to add in new people, new qualified immigrants that are coming into the country, who are coming in with means and coming in with resources or family to help them purchase home. And as we talked about 45 to 50% of new to Canada people that once they get their PR status or once they're landed are going to be purchasing a home in the next 5 years. So this is something that we do need to take into consideration. And although there are many factors in regards to why home prices are doing what they're doing, and there's no one particular point that's going to be stronger than the next. It's just literally looking at it and saying, okay, if you are looking to get into the housing market, you may need to shift your focus. If you're looking at buying a detached house, maybe, you have to look at a town, maybe you have to look at a stacked town, or maybe even a condo. So a lot of advice that we're giving to clients who are maybe buying insured or have 20% down, it all depends on their game plan, because as of right now, still, the government has not introduced new legislation to basically say, hey, we're increasing the threshold for insured mortgages. We're still at below $1 million if you're looking for an insured mortgage. Now, when we talk about interest rates with Canada and the Bank of Canada, one thing I do want to discuss is that the Bank of Canada has to look at what's happening globally in order to make their fiscal decisions on monetary policy. And that is something that's important because as we see tensions rise in the Ukraine and Russia, we're starting to see some, corrections in the stock market. We're starting to see, investors pull out into different vehicles. These are all things that the Bank of Canada has to take into consideration. All the elements, including, the amount of debt that is in the system, what the GDP is, what is inflation look like, where are the jobs, what is happening across the country. And that's why, for me, is my personal opinion is, when you see articles that say, hey, we're going to increase rates 8 times. January 26th passed. They didn't increase interest rates. The next meeting is on March 2nd. We are anticipating rates to go up on March 2nd. But, if they were to increase it 8 times, the Bank of Canada meets 8 times. And, in my professional opinion, and this is just an opinion, I don't see the Bank of Canada increasing it 7 more times this year. And that is because once they increase the interest rates, they do need to sit back and basically monitor the situation and say, okay, we've increased interest rates here, and this is the response that we're getting. This is what the markets are telling us. This is what we're seeing. The debt levels, everything's changing. Is inflation coming down? Because the major concern for the Bank of Canada, in my opinion, is, although they want to try to do their best to try to fix all the different parts and facets of what's happening in the country, their goal is to bring inflation back down to its target rate of 2%. And in order for them to do that, their hands are tied. The toolbox is sort of empty, and they're saying, okay, well, you need to increase interest rates to help bring inflation down. But, we're still facing supply chain issues. We're still facing manufacturing issues. And just to give you a context, when I look at the Canadian Consumer Pricing Index, the CPI, as of January was at 5.1%. Okay. Now at 5.1% as opposed to the US at 7.1%, obviously housing, heating, these are all things that we need, food, all these things are important. But one major distinction in between the two buckets is that the US actually considers used car prices as part of their consumer pricing index, where Canada doesn't. So, we can sit here and have a discussion about why I think 5.1% is not an actual real number. When it comes to inflation, it's much, much higher. And those of you that are out there at the grocery stores or purchasing, goods or trying to get goods, trying to find certain items, you'll see that, things are very expensive, especially when it comes to heating and providing food for your family. So one reason why I'm saying to Canadians not to fear the rate increase to the Bank of Canada is that if it helps bring inflation back down to its target range, which I think that we're sort of at the tipping point of where we are with inflation. I mean, as I said, we're starting to see some light at the end of the tunnel, and that inflation should be coming down hopefully by the summer. I'm making a prediction. I hate making predictions, but when you start to look at some of the pieces together, you have to look at things globally, right? The Bank of Canada has to be strategic in what they do. They can't, governments and bank policies and, central bankers, they have a tendency to maybe overreach and then having to pull back. And we've seen this in the past, and I've said this many, many times before. They might be a little bit aggressive this time, but they might sit back for a few meetings and not do anything at all. So if you're in a fixed rate mortgage, obviously, you have nothing to fear in regards to any of the Bank of Canada policy rates, as that's basically a fixed rate mortgage. Now, variable rate mortgages are, a different animal on its own. And what we do see is if the Bank of Canada does increase 1.25%, it could mean anywhere from 11 to 12 per $100,000. So this is something that's important to understand, that, if you're a 1/4 point increase to, let's say 1.5%, you go to 1.75%, that's about $11, almost $12 per $100,000 per month, which could be, if you have a $500,000 mortgage, around $60. So, if that's going to be significant amount, I mean, obviously that's 60. The one important thing is it can go 60, 120, 240. There could be some significant changes in there. But what I want to do is express one thing. As of right now, we're seeing fixed rates around 3% over plus 3%. And the current variable rate mortgage is still around 1.45 to 1.6%, which means if you're locking into a fixed rate mortgage, you could be leaving about 1.5% on the table. And that is a significant amount of money that could be going towards other vehicles or other things that you as the consumer, as the mortgage holder, can be utilizing for other things, or investing, building your investment portfolio, maybe paying out some additional debts that are at a higher rate of interest. But one thing to understand is, as I said, with the variable rate mortgage, you do have the ability to get out of that mortgage with the least amount of penalty at any given time, depending on your lender. But the majority of lenders that are on a variable rate mortgage or offering a variable rate are 3 months interest and you're out. Remember, variable, you can lock into a fixed. From a fixed, you cannot go into a variable. So what I do want to just end off with one thing is that if you're coming up to mortgage renewal and you've gotten your mortgage statement and you're looking at the maturity date saying, hey, I'm coming up in 6 months, a year, look at your options and say, what am I doing? What do I plan to do? Maybe jot down some ideas. Think about if you're planning to move, if you're planning to renew. A lot of times clients will come to us and say, look, I don't need to touch my mortgage, but I want a line of credit. Maybe I want facility. Maybe I'm doing some rentals. And, there are a lot of things that people will look at. And that's why I always say, when your mortgage comes up for renewal, you're approaching renewals, always reach out to your mortgage professional, get that opinion in regards to, what you should be doing or what you should be considering. No one's forcing you to make a decision, but having a conversation about what your options are always important, even if you're contemplating locking into a fixed rate mortgage now ahead of March 2nd. But as I said, for me personally, my opinion is that, there's not much to fear if you're in a variable rate mortgage, but obviously it comes down to the consumer, the mortgage holder, and what you're comfortable with. If it's locking into a fixed rate mortgage and paying a premium to lock into a fixed rate mortgage is going to help you sleep at night, then hey, I suggest doing it. If you think that a variable rate mortgage is the best option because you're going to be putting more money in your pocket, that is your decision. As I said, as mortgage brokers, we just have a conversation with our clients about what they feel, understanding their appetite for risk and understanding their tolerances and what is the best decision for them. So I hope you found this video helpful. If you have any questions, always feel free to reach out to us at InTouch Mortgage Solutions. Our team is always here to help you. So have a great Friday and even better weekend ahead. Until next time, we'll see you later.